traders use RSI then?
Traders use RSI to measure momentum in the price. Remember, momentum is the strength of a price move, not how volatile it is. RSI is a leading indicator, which means it's designed to lead the price action.
Right, so in practice, this would mean it acts as a potential reversal signal?
Yes, that's right. Signals can be generated by looking for overbought, oversold setups, centerline crossovers, divergences, and failure swings. RSI can also be used to identify the general trend.
What's a failure swing? I haven't heard that term before.
Don't worry, we'll look at failure swings in a few minutes.
Okay, sounds good.
Traditionally, and according to Wilder, RSI considers a market overbought when above 70 and oversold when it's below 30. Let's look at our chart of gold. We can see RSI enters the overbought zone here in April and again at the end of August.
Yes, I can see that.
So, both these overbought readings are followed by pullbacks in price. This is when momentum was too strong and gold became overbought. For all its strengths, RSI is still just a momentum indicator, which means in sustained trends, like gold had here at the end of last year, it can cross over into a zone and just stay there, especially if the periods we've specified for the indicator end up being shorter than the trend.
You mean because the trend is longer than the 14 days we've set the indicator up for, it shows a sustained oversold signal?
Yes, you've put that well.
So why don't we just increase the number of periods we set for the indicator?
Some traders do. Some traders check RSI for several period lengths, like we do with moving averages. Try not to change the indicator's parameters to justify your point of view. What if the trend lasted even longer next time? The fact remains that this is a weakness of all the momentum indicators we've seen.
I see your point.
We will come on to how to set yourself up and what exactly to look at in the final module. Like many momentum oscillators, overbought and oversold readings for RSI work best when prices move sideways within a range.
Noted. Thank you.
Okay, now let's look at divergences. This is similar to the divergences we looked at with stochastics. Analyzing the RSI highs and lows against the highs and lows of price can provide insights into the changing strength of bulls or bears. When divergence occurred, Wilder considered this an indication of a potential trend reversal. Let's pull up a chart of daily DAX with an RSI of 14 to explain what I mean. Here, a high in the price is formed in line with the RSI crossing over into an overbought zone and forming a high in its own right.
Yes, I see that.
The divergence occurs later when we see a slightly higher price reached here, but not a corresponding higher high in the RSI level. You can see RSI has actually dropped below the 70% threshold. That's divergence.
So, when a high is reached in price, but that isn't reflected in a higher RSI level, this would be seen as a potential change of sentiment that traders might take advantage of.
That's right. We would consider this a bearish signal because the bulls appear to be weakening. The price saw a new high, but the momentum generated to reach that new high was not as strong. The bulls are running out of steam.
Got it. Thanks for explaining. Is the same true when the price forms new lows, but the RSI doesn't reciprocate? Are the bears running out of steam?
Precisely. That's a bullish sign. Okay, let's look at RSI trend lines. We haven't conducted technical analysis on an indicator itself yet, but traders can analyze the trends in RSI to assess trends in momentum. If the price can have support and resistance levels, then why not momentum?
I think I'm a bit lost.
Let me show you. If we draw a trend line on the divergence we spotted earlier, applying the rule about confirming it with 3 touches, we can see that it later acts as a resistance twice, here and here.
Yeah, okay. Does it have to be on a divergence?
No, that was a handy coincidence. Both times the RSI has fallen back, as has the price. We can say there has been resistance to the momentum strengthening.
Right, and is it important when the RSI later breaks that resistance in August?
You bet. Look, the old resistance line then acted as support before the bulls gathered strength and pushed the market higher. RSI has on occasion been better at showing support and resistance levels. This type of analysis on the indicator itself can extend further to patterns, which we are going to be covering in our next module.
So how can RSI help us identify trends then? I thought it was a momentum indicator.
Well, you need strength in momentum to develop an uptrend and weakness for a downtrend. RSI tends to fluctuate between 40 and 90 in a bull market, with the 40 to 50 zone acting as support. In a downtrend, it fluctuates between 10 and 60, with the 50 to 60 zone acting as resistance.
So, depending on where the RSI level sits, we can identify an up or a downtrend in price.
Yes, broadly, it's another layer of analysis we might conduct to understand the trend. We can see something similar with our gold example. Here, where the trend is bearish, RSI is between 60 and 20.
I see that.
Later in the chart, when we can clearly see an uptrend, RSI spends most of its time above 50. RSI pullbacks to the midpoint can be seen by some traders as an additional buying opportunity.
Right, so because RSI stays above 50 most of the time, it helps us confirm it as an uptrend.
That's right. RSI's neutral level is 50. If it rises above, it indicates an uptrend. If it falls below 50, it indicates a downtrend. Traders take this a step further at times and consider an RSI crossover above 50 as a trigger to buy and crossover below 50 as a trigger to sell. These are called centerline crossovers. We mentioned failure swings earlier in the lesson. Let's look at them in a bit more detail now.
Ah, yes, I remember these were mentioned. What on earth are they?
So, Wilder also considered failure swings as strong indications of an impending reversal. Failure swings are independent of price action. In other words, failure swings focus solely on RSI for signals and ignore the price. A bullish failure swing forms when RSI moves below 30, bounces back above 30, pulls back, holds above 30 and then breaks its prior high.
I see. So it's kind of like a bouncing ball movement?
It's basically a move to oversold levels and then a higher low above 30. The bears tried to find some momentum as before, but the bulls wouldn't let them.
And can we get a bearish failures?
Yes, these are when RSI forms a high in overbought, then a lower high below the 70 line.
So I'm starting to realise that every indicator has its downsides. What are the limitations of RSI?
Well, it's still just a momentum indicator. It works well in a ranging market, like the second half of the gold example. But like stochastics, it can fall over in sustained trends.
Ah, okay. So where there is momentum for sustained periods of time in a market, in long trends, RSI isn't really useful.
Well, it tells us there is momentum, which is its job, but if it's being used to initiate trade signals, it can give a lot of false ones in these periods. It can stay overbought or oversold for too long.
Thanks for confirming.
The other aspect I don't particularly like about RSI is some of the analysis methods concentrate just on the RSI figure and ignore price action. I've shown you a couple in this video, like failure swings.
What's wrong with that?
Well, if done in isolation, traders end up trading the indicator and not the price. This can be true of any indicator, but RSI happens to be the one I've picked on to make this point. Indicators are there to provide us with analysis. Remember, trade the price action, not the indicator.